Hi, and welcome to your Lallic Partners entry course. This course is designed for people who would like to learn about investing in the stock market. By the end of this 7-unit course, you can expect to know about fundamentals of investing, such as diversification, how to view financial reports, how to find good investments, discovering the intrinsic value through DCF analysis, analyzing the overall markets, and more. Okay, let's start. Your instructors for this unit are going to be Eugene and I. In Unit 1, you can expect to learn about the basics of investing. This includes the ability to diversify your portfolio, read financial reports, different types of investment funds, including Lallic Partners itself, DRIP, and index funds. So, before we start getting into complicated topics, let's talk about the fundamentals. What is a stock? Stock is essentially a share of a company, meaning that if you purchase a stock, you're buying a part of the company. However, that doesn't mean you get to decide what goes on in the company because your stake in the company would be too small. So, to make money, the most common way is to buy a part of the company when the company itself is undervalued or if it has more room to grow. After you invest, you should sell when the value of the company is high and that you think the company has reached their potential value. That method is called going long on an investment. On the other hand, if you believe that the company's value is going to go down, you can short the stock. That means that you borrow a stock from someone in the world and then sell it on the market. Once the price goes down, you can buy back at a cheaper price and you can profit from the spread between how much you borrowed it for and how much you bought it back for. But be careful with this method because not only are there higher commissions taken when going short, but also you can actually go in debt from your investment as short. This is because when you go long, the most you can lose is how much you bought because a company cannot be valued negatively, but a stock may keep going up, multiplying by 1,000%. This means you lose 1,000% of your investment. There are also stocks with different volatility. A blue chip is a major company such as Microsoft or Apple, which are considered as safe investments because the company itself is stable. On the other hand, there are mid-cap stocks and penny stocks. Mid-cap stocks are just a little more risky, but penny stocks are extremely risky. You shouldn't distribute much money into penny stocks due to its uncertainty. But why do people buy penny stocks? It's used by day traders due to high volatility, and stocks are always high risk, high return. You have to be able to manage your risks, which we'll cover later on. Dividends. Dividends are for everyone, but dividends are a necessity for people of older age. They need more security, and since they won't be working, they need passive income. Dividends are paid either quarterly or annually, and the amount is a certain percentage of the person's holdings of the company. Dividend companies are usually of bigger scale, such as Boeing. However, Boeing does not currently offer any dividends because they are under the coronavirus crisis and they need to cut expenses. At Lallic Partners, we do hold companies with dividends, but they're not the main reason why we bought it. Now, DRIP. Now, that we have learned about dividends, we can learn about DRIP. DRIP stands for Dividend Reinvestment Plan. This simply means that whatever dividend you get from the stock, it automatically gets reinvested back to the same stock. This is beneficial if you want to grow your money faster from compound growth, and if you don't need any passive income at the moment. Now, what are exchange traded funds? These are traded in the stock market as stocks, so you can easily buy and sell them like a stock. ETFs represent many things. They can either combine multiple stocks into this one ETF, track an index, a commodity such as oil, go short on some assets, and they're all represented by a company. ETFs can also increase volatility in specific assets. For example, SCO and USO are great examples. USO is United States Oil Fund, which the price rises when oil prices rise. SCO is actually the exact opposite. It's like going short, but it's not really. You have the same benefits as going long, but it's just an inverse stock. When oil prices go down, the price goes up. You can read more about ETFs and oil on Lallic Partners news section. Now, a bull versus bear is the fundamental symbol of investing. If someone says they're bullish on a stock or even the stock market, that means they predict that it is going to go up. When someone is bearish, they predict that a stock or a market is going to go down. Recently, due to COVID, the bulls and the bears started to sound like a political debate. We'll talk about the current economic conditions later on. So, how do you get into investing into public assets such as stocks? My first ever brokerage was Poems, a brokerage based in Singapore. It was great because since I'm a Singapore dependent pass holder, I am able to trade from Singapore, meaning that I'll be able to trade without any fees taken from Singapore. A high tax location, for example, is California, where you would have to pay for state and federal tax. In California, they will roughly take about 24% of profits from stocks as capital gain tax. In investing, you also have to counter in the commission taken by the brokerage itself. In Poems, they take around $20 every time I bought and sold, no matter if the trade was profitable or not. This was a huge mistake when I was day trading with Poems because there were many transactions. So I decided to move to Interactive Brokers. I personally recommend this one because of its extreme low commission fee with a solid interface. For casual investors, they can use Robinhood, where you can start as low as $1. Interactive Brokers does not require much starting capital either, but Robinhood is much easier to use. Robinhood is accessed from your mobile device. In investing, you can leverage your money for higher returns with little money, but with leverage, your money is much at risk and you can lose much more than the amount you started with. I would not recommend this, especially when you're getting started. To open a brokerage account, since many of you are under 18, you cannot open one yourself. You must ask your guardian parent to open the account under their name, and you can log in and trade for their behalf. Okay, so what affects stock prices? The three main categories are leading indicators, coincident indicators, and lagging indicators. We'll talk about specific events that affect stock prices. In stocks, you often do not worry about equations and theories you learn in AP economics. The first indicator, which is the leading indicator, is the stock market predicting the future. It is known that the stock market represents the future economy, such as 6 to 9 months in advance. This is one of the reasons many people say that the stock market does not represent the economy, calling it the growing gap between Wall Street and Main Street. Next is the coincident indicator, which is abrupt news that is in the present. Some examples are the unemployment rate figures and corporate earnings. Lastly, a lagging indicator is something that gets confirmed afterwards, such as GDP or inflation that is affected by a decision made by the federal government, such as printing trillions of dollars. After printing trillions of dollars, the inflation is then confirmed by data after some time of printing money, and so that is called a lagging indicator. Now let's go back a little bit and talk about the gap between Wall Street and Main Street. There is a big misconception for new investors and even some experienced investors is that they think the stock market has to represent the economy. When looking at what consists of the stock market, almost 20% of the market is controlled by the big three, which is Apple, Microsoft, and Amazon, which all boast a market cap of over $1 trillion per company. Additionally, a lot of the smaller companies and private companies are excluded from the stock market. This means that the economy, which is the GDP and other factors, are not reflected by the stock market. However, the gap is too wide at the moment. This is a dangerous gap, which is mentioned by the economist. The stock market is also reflecting the future and not the current economy. So the lesson to take away here is that macroeconomics, such as GDP, does not affect stock markets as much compared to Apple's quarterly earnings. This will counter into the COVID-19 possible market crash that we'll talk about later on. Thank you for listening, and see you in the next topic.